In 2023, a school teacher in Ohio opened a letter from the IRS. She had filed her return the same way millions of Americans do, gathered her documents, submitted everything, assumed that was the end of it. It was not. The IRS wanted documentation for her home office deduction, her charitable donations, and side income she had earned selling items online. She had none of it. Not because she had done anything wrong, but because she had never been told she needed to keep it. By the time it was resolved, she owed over $9,000 on income she had already paid tax on once. Her story represents thousands of real cases documented in IRS audit records. The IRS closed more than 500,000 tax return audits in fiscal year 2024, and the majority of those people believed they had done everything correctly. Here is what they did not know, and what you are going to know by the end of this video. Here is what most people get completely wrong about IRS audits. They think they are random. They are not. They are triggered. When you file your return, it does not go to a human being first. It enters a computer system that runs what is called the Discriminant Information Function Score, the DIF score. Think of it as a credit score for your taxes. The system compares your return against statistical averages for people in your exact income bracket. If your numbers look dramatically different from what it expects, your score goes up. The higher the score, the more likely your return gets pulled for human review. Now, here is the picture for 2026 specifically. In 2025, the IRS significantly reduced its workforce, including a large portion of its auditing staff. So the odds of a traditional face-to-face audit are at a genuine historic low. Some people hear that and think they are off the hook. Here is what those people are missing. There are two completely separate ways the IRS can come after you. Traditional audits, a human examiner reviewing your return. That risk has gone down. And the automated system, software that cross-checks your return against every W-2, every 1099, and every brokerage statement the IRS already has on file. That system was never cut. It never stopped. In fiscal year 2024, the automated system generated over 1.2 million notices, more than double the number of traditional audits, resulting in $7.7 billion in additional tax bills, without a single human auditor involved. The IRS has also been layering in artificial intelligence and advanced analytics to catch patterns the old models would never have flagged. That was not cut either. The honest picture. The chance of an agent reviewing your return has gone down. The chance of a computer finding something wrong and sending you a bill has not. For most people watching this, the automated system is the real risk, which is exactly why what we are about to cover matters more than ever. Stay with me through all 7, because red flag number 5 is the one that carries a risk most cash business owners have never heard of. And it is not just an audit risk. It is a federal crime. Here are the 7 things the IRS system is specifically looking for in your return right now. Red flag number 1, deductions dramatically out of proportion to your income. If you earn $60,000 a year and you are claiming $45,000 in deductions, that immediately looks unusual, even if every single deduction is completely legitimate. The IRS knows the statistical average of what people in your income bracket typically claim. When your number is dramatically higher than that average, the DIF score spikes. This is especially common with Schedule A itemized deductions, mortgage interest, state taxes, medical expenses. To be clear, claim every deduction you are legally entitled to. Do not leave money on the table. But you need documentation for every single one. If the IRS asks you to prove a $12,000 mortgage interest deduction, you need a Form 1098 from your lender immediately. No documentation means you lose. The fix: organized records throughout the year. A folder on your phone organized by month. Receipts, statements, records. Clean documentation means audits resolve quickly and in your favor. And this matters. The next red flag is the one the IRS catches automatically. No guessing, No assumptions, just data it already has before you file. Red flag number 2, unreported income. The IRS catches this automatically because they already have the information before you file. The IRS receives copies of your W-2s, your 1099s, and your investment statements from banks, brokerages, and employers before your return arrives. When it comes in, the computer cross-checks everything automatically. A gap of even a few $100s, that is a flag. 3 situations where this hits hardest: side income, rideshare driving, selling on eBay or Etsy, freelancing, payments through Venmo or Cash App, all taxable. Here is where people got confused recently. Under the One Big Beautiful Bill Act signed in 2025, payment apps are required to issue a 1099K only if you receive over $20,000 and have more than 200 transactions in a year, and both conditions must be met. A seller with $50,000 spread across 150 transactions does not trigger the form. A seller with 500 transactions totaling $9,000 does not either. But that threshold only determines whether you receive a form. It does not determine whether you owe tax. Every dollar earned through a payment app is taxable income, whether or not a form was issued. Staying under $20,000 does not mean you are in the clear. The IRS expects full self-reporting, full stop. State note: Vermont, Massachusetts, Maryland, Virginia, and Washington, D.C. have their own thresholds as low as $600. Always check your state separately. Investment sales, stocks, cryptocurrency, property. If you sold and did not report the gain, the IRS already has it from your brokerage's 1099-B. Rental income. Every dollar from a tenant is taxable. Report everything. No form. Cash. One time. It does not matter. Red flag number 3. Round numbers on your tax return. And once you see this, you will not be able to unsee it. Real business expenses are almost never perfectly round. Your office supplies do not cost exactly $500. Your business travel does not total exactly $3,000. Your advertising is not exactly $10,000. When the IRS sees a return full of perfectly round figures, $5,000 in meals, $8,000 in supplies, $12,000 in travel, it signals that these numbers were estimated, not documented. Because real numbers have sense, real numbers are specific. People know roughly what they spent but did not keep receipts, so they round. And that pattern is visible to the computer. The fix is simple. Track actual expenses. Your real numbers will never be perfectly round, and that specificity is exactly what the IRS expects. Use Expensify or Keeper, or photograph receipts and drop them into a folder on your phone by month. 30 seconds per receipt, potentially thousands of dollars saved. Red flag number 4, the home office deduction. After COVID, millions more Americans started working from home and claiming a home office deduction they are not entitled to. The IRS knows this and specifically looks for it. The legal rule, plainly stated: the space must be used regularly and exclusively for business. Exclusively. A spare bedroom with a desk and a television where you occasionally work does not qualify. A kitchen table that doubles as a workspace does not qualify. And here is the rule most W-2 employees do not know. If you are a regular W-2 employee working from home, you cannot claim a home office deduction on your federal return. Eliminated by the 2017 Tax Cuts and Jobs Act. Not restored. One exception. Some states, including California, have not adopted this federal restriction. W-2 employees in those states may still qualify on their state return. Check your state rules or speak with a CPA. If you legitimately qualify, 2 options. The simplified method, $5 per square foot, up to 300 square feet, or the actual expense method with full documentation. Keep a floor plan. Know your exact square footage. Now, This next one involves something most people consider entirely positive. Red flag number 5. Charitable donations disproportionately large relative to your income. Charitable giving is one of the most powerful deductions available, and the IRS fully supports it. But there is a threshold beyond which your return looks unusual. The average American with a $75,000 income donates roughly 2 to 3% to charity, around $1,500 to $2,200. Claiming $18,000 in donations on that same income, nearly 24%, will raise a flag. If you genuinely gave that amount, you are entitled to the deduction. But the rules are specific. Cash donations over $250, written acknowledgement from the charity required. Non-cash over $500, Form 8283 required. Non-cash over $5,000, qualified appraisal required. One common mistake: donating clothing and household items and significantly overvaluing them. Use the IRS's own valuation guidelines or get a receipt from the charity with a fair market value estimate at the time of donation. And this next one does not apply to everyone, but if it does, your risk goes up substantially. Red flag number 6. Cash-heavy businesses. Restaurants, barbershops, nail salons, food trucks, landscaping, cleaning services. Any business where a significant portion of transactions happen in cash.
The IRS is well aware that cash businesses carry a higher potential for underreporting and audits them at significantly higher rates than other business types. 3 things specifically get you flagged. Reporting income that does not match your industry. If comparable businesses in your area report significantly higher revenue than yours with the same size operation, that is a flag. Reporting expenses that consistently exceed your reported income. And large cash deposits followed by withdrawals that do not match your reported business activity. One thing many cash business owners do not realize: banks are legally required to file a currency transaction report for any cash transaction over $10,000. And if the IRS suspects you are intentionally breaking up transactions to stay under that threshold, that is called structuring. It is a federal crime under 31 U.S.C. Section 5324. Regardless of whether the underlying income is legitimate. The fix? Meticulous records. Wave accounting software is free. QuickBooks is widely used. Record every transaction. Pay vendors by check or bank transfer where possible. A paper trail is your protection. Now, here is where the IRS stops asking whether you made a mistake and starts asking whether what you are running is actually a business. Red flag number 7, and this is the one that catches people who are genuinely building something. If your business reports a loss every single year, the IRS stops asking whether you made a mistake and starts asking whether this is actually a business or a hobby being used to generate deductions. The IRS has what is called the hobby loss rule. If your activity does not show a profit in at least 3 out of 5 consecutive years, the IRS can reclassify it as a hobby, and hobby losses cannot be deducted against your regular income. This affects Etsy shops that consistently lose money, photography side businesses that never reach profit, consulting practices in early years. Rental property losses are a separate matter governed by passive activity loss rules, and qualifying as a real estate professional under IRS guidelines changes the picture significantly. Now, watch what happens when the IRS makes that reclassification. Every deduction you took against your regular income in those loss years, potentially reversed. Every dollar of tax benefit, potentially owed back, with interest. That is not a letter asking for documentation. That is a bill. To protect yourself, document that you are operating this as a real business with genuine intent to be profitable. Keep records of your marketing efforts, your business planning, your strategy adjustments over time. Show that you are genuinely working toward profitability, even if you have not reached it yet. If your side business consistently shows losses, speak with a CPA about how to structure it correctly. The structure matters, the documentation matters, and the difference between a business and a hobby, in the eyes of the IRS, could be the most expensive distinction you never saw coming. You now know all 7, and knowing what triggers a flag is only half of it. The other half is 5 specific things you can do right now so none of these ever apply to you. 5 steps right now. Step 1, document everything all year long, not just at tax season. A simple folder on your phone organized by month. Receipts, statements, records. Clean documentation means audits resolve quickly and in your favor. Step 2, be accurate, not creative. Claim every deduction you are legally entitled to, not a dollar more. If you are unsure whether something qualifies, ask a professional before filing. Do not guess. Step 3, use a CPA if your finances have any complexity. Self-employed, own a business, investment income, rental property. A CPA is worth every dollar. For a complex individual return, expect $500 to $2,000 or more, depending on your situation. A good CPA does not just complete forms. They know how to present your return accurately in a way that reduces audit exposure. Step 4, file electronically and on time. Paper returns have higher error rates. E-filing reduces them. Filing on time or requesting an extension keeps you in good standing. Step 5, know your rights. More than 3 in 4 IRS audits happen entirely by mail. It is not an agent at your door. It is usually a letter asking you to verify one specific item. You have the right to respond in writing. You have the right to have a CPA or tax attorney represent you. You do not have to speak to the IRS directly, and you have the right to appeal any decision. Getting audited is not the end of the world, especially when your records are clean. You now know the 7 audit red flags most Americans never see coming. File smart, stay compliant, and avoid unnecessary IRS attention. Next, the legal tax strategies wealthy Americans use to reduce federal taxes. So please subscribe.